Yeah, I mean, we saw that 162 level very close to that level back in July, right? And then we saw that massive appreciation of the Japanese yen. But those long bullish bets have sort of taken a hit this month, and we have seen that in the options market already. And it's really about the function of the Federal Reserve, right? Because we saw that messaging coming from Chair Powell. Nobody should be assuming that the easing will be in the magnitude that we've seen in this rate cut of 50 basis points. So after we got those comments, we actually had the Japanese yen weakening. And the volatility has been pretty strong because earlier in the week, on Monday, the yen actually touched 139. Now we're at 142, 143. And depending on what Governor Ueda also says this afternoon, we could see more of an impact on the Japanese yen. But a lot to do with what's happening with the BOJ tightening itself, with the Fed easing, and how investors try to capture that in the markets. We have seen the 2-year Treasury yield now continue to fall. Treasury is pretty mixed. But the fact that there is more of a sense that the Fed will be a little bit more gradual when it comes to easing, that has put a little bit of pressure on the Japanese yen. We also have to consider that we're headed towards the LDP presidential election next week. Depending on who gets elected, and the visibility right now is pretty low, that could also potentially have an impact on the Japanese currency. According to Barclays, if candidates such as Ms. Takaichi, who has talked about the need for more BOJ easing, that could actually lead to more yen weakness.
Factors come into play. You got to wonder just how much clarity you would get from the conference later today from Ueda.
Yeah, we're going to be really watching his comments around the inflation outlook, his comments about the real rates, because Governor Ueda has already said the real rates remain very low. So despite the fact that we are seeing this tightening trend here in Japan, real rates remain low. And we'll really want to watch what he says around consumer spending as well. That was included in this statement about improvements in consumer spending, but it's always been about really trying to bring that virtuous cycle of consumption here in Japan. Because despite the fact that we had a weaker yen and inflation accelerating, especially core CPI this morning accelerating for a 4th consecutive month and being above that 2% BOJ target for more than 2 years, it's really being about trying to get prices sustainably higher by having Japanese people go out and spend, and that's been a much more difficult task for the BOJ and broader policymakers.
Sherry on with the very latest, and of course, just recapping the BOJ doing what is widely expected, standing pat at 0.25% so far in terms of reaction. The yen and the Nikkei, very little reaction there, perhaps fully priced in. Now, elsewhere in the market, it feels like a feel-good Friday. We're seeing an expansion in terms of stocks in Asia. MSCI Asia-Pac Index up about 2%, extending that rally we've seen globally. Remember that global stocks are at new record highs. It does help that 50 BPS cut by the Fed has not led to any panic in the market. In fact, the reversal has come through, and we have the U.S. jobs data as well, suggesting perhaps the Fed will be able to engineer that soft landing it has been talking about. Just bear in mind, global monetary policy is diverging at that point in time. Beware of that particular risk. We're keeping an eye on Hong Kong. It is in the money. Property plays in focus. Of course, we're talking about Chinese property plays on the back of Evergrande hearing today. Liquidators looking to unwind a unit of Evergrande with key assets. If successful, it would be a big victory for them. And of course, we want to take a look at the yuan. It is pretty much well supported at the strongest level in more than a year. The fix, by the way, was the biggest since March 2023. Let's take a look at how it's looking in the overall picture. Sentiment pretty much lifted. Indonesia, though, right now down about 1.5%. Also losses for the New Zealand benchmark, currently lower by 0.8%. In the FX space, Asian currencies, as you can see, pretty much well supported. The rupiah up 0.9%. Of course, we've seen how those emerging market currencies in this part of the world, in particular the Malaysian ringgit, has been really going gangbusters, among the best performers right now, up about about 0.5%. Sentiment lifted by the moves by the Fed, as well as the BOJ standing pat as expected. Let's get assessment on that move by the BOJ. Oh, no move at all. Staying pat at 0.25%. Sherry Yeon in Tokyo. Sherry.
Yeah, we're still trying to digest that statement coming from the Bank of Japan, and we're really focusing on those comments around financial stability, especially the forex markets. So the BOJ says they need to pay attention to that. There's high uncertainties around the economic activity and prices in this economy. But let me bring in my next guest, who's Sayuri Shirai. She's a former BOJ board member. She's also a professor at Keio University. Sayuri, thank you so much for coming out here, being in the sun with me, trying to digest what the BOJ is doing from here. But they didn't move, right? That was pretty much expected.
Yes.
And you think it was because the yen strengthened a little bit?
Yes, because last time when they made quite a surprising decision at the end of July, and until the second half of July, first half of July, there's a lot of depreciation, like above 160. But now, it's more appreciated around 142, 143. So there is no strong reason why BOJ needs to take action right now, because the domestic demand is not very strong.
The BOJ in a statement saying that FX is more likely to affect prices than in the past.
Yes.
What sort of impact could we see?
I think, the Fed started to lower interest rate now, and then they are going to lower it towards 3% over next 2 years, right? But still, 3% and Japan's low interest rate, there's a big interest differential. So it's possible that yen, will start to appreciate, but remain at the quite depreciated level than the past, like 120 or 130. Then still, imported prices will be affected, right? It's not really demand driven, but it's mainly from imported cost push inflation. I think BOJ acknowledged there can be such kind of exchange rate impact for in the future as well.
And you saw that really demand-driven inflation was not in place, even the core CPI numbers this morning.
Yeah, so this morning, headline inflation was 3%. More than 60% of inflation comes from food and energy. It's basically cost push. And this structure hasn't changed over, this past year. And if we look at the services inflation, it's dominated by hotel fee and the overseas, travel fee. Just two items account for 40% of services inflation. So it's really nothing to do with domestic demand, right?
Does that mean then that the BOJ can continue to tighten? Can it raise rates further this year, or does it get pushed out?
So from the point of domestic demand, I don't see any reason why BOJ should raise interest rate, right? But I think BOJ took action in July because of the excessively cheap Japanese yen. Now still Japanese yen is cheap at 140 level. So BOJ have to be cautious. So probably Governor Ueda today at the press conference may do not deny any possibility of further interest hike, because otherwise, markets think, okay, BOJ will not take any action, so it may depreciate Japanese yen again. So BOJ have to act very cautiously, and there's a dilemma. But in terms of domestic demand, I think they want to maintain low interest rate.
We really don't want to be in his shoes, do we? I mean, it's going to be such a tricky messaging act.
Yes.
What can we expect in terms of other tools that we could see from the BOJ? Because, okay, so they cut the pace of bond purchases by half. We know that normalization is happening. What happens to other tools that they've used in this extraordinary period, say ETF holdings that are huge as well?
So at the July 31st meeting last time, when somebody asked, what Bank of Japan is going to do about this reducing ETF holding, huge amount of holding, and Governor said, please give me time. And at this moment, it's a bit very risky for BOJ to start to reduce ETF holding, because now yen is on the appreciation trend. It will lead to the decline in the profit in the exporting sector, which will undermine stock prices. So, I think it's not good time for Bank of Japan to take action on that. Even maybe they are thinking in the future, but it's kind of double impacts to the stock prices.
I mean, investors will take that and run with it, right? But the BOJ is saying financial conditions have been accommodative. And that's true, right, when it comes to real rates?
In terms of real interest rate, still very negative, right? Because inflation is 3%, interest rate is just 0.25%, very, very big negative interest rate. However, we have to be careful. BOJ say it's more accommodating because of the real interest rate, but inflation is cost push. So company feel, they don't feel really, financial condition is accommodating because it's cost push. Their input costs are rising, right? It's depressing their profit. So, real interest rate is negative. It's accommodating in the economic sense, but it doesn't mean the company feel financial conditions are accommodated. Indeed, cost push inflation, higher inflation. I don't think they are not taking this as a positive situation.
Which takes us full circle to the fact that demand-driven inflation will be very tricky, right? I mean, if businesses don't feel that they can be more aggressive in terms of activity and animal spirits don't return, they're not going to hike wages more. But we have seen some changes there too.
Yeah, so we started to see quite high wages, especially in the past 2 months, about 3%. So it's quite clear that real wages has finally started to pick up in the positive territory. But most of these increases come from bonuses, like a one-time for all, bonuses. It's not like a regular,
base pay, though, the increase as well.
Yes, but not so much. But basically because of the bonuses, right? So, and then this year, company tried to raise wages, partly because we have a serious labor shortage. Unless they pay more wages, nobody comes, right? But it doesn't mean they can continue wage growth at such level next year or 2 years after, because Japanese economy is quite sluggish, right? Corporate sector does not really improve their labor productivity. Then it damages the profits, right? So nobody knows whether this year's wage growth will be sustainable.
It sounds to me that if you were still at the BOJ, you would prefer to hike rates next year. Is that correct?
If we don't need to worry about exchange rate, I think maintaining current interest rate is the best option.
However, if we see more yen weakness, it would be sound to act.
We may have to, yes.
Sayuri Shirai, always great to see you on BOJ Day. Outside here in the heat with me. Thank you so much. She's professor at Keio University and, of course, a former member of the BOJ as well. Back to you guys. Has.
Sharian, thank you so much for that. Let's do a check on how Japanese assets are doing. The yen in particular, it stood pat initially, but a tad stronger at this point in time as we speak after that BOJ decision, of course, standing pat. We await that the comments from Ueda, whether he has any signal, any indication what he might do later this year. Another hike, perhaps. Comms are key. Of course, Nikkei futures maintaining the gains that we saw earlier. Of course, Japan on lunch break. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia, and we have breaking news right here. Bloomberg has learned that China is considering removing some of the largest remaining restrictions on home purchases after previous measures failed to revive the market. Of course, China has been saddled with this property crisis, and it's been struggling to reverse the weakness in its economy. Let's bring in our China correspondent, Min Lo. Min, walk us through the new measures. What are we hearing?
Yeah, quite a number of measures that Beijing is said to be mulling, according to sources. So they are looking to roll back restrictions that would have prevented non-local buyers. I'm referring to those without their hukou or household registrations tied to the cities that they want to buy a house in. So Beijing is looking to roll back some of those restrictions. In the past, some of these requirements include having to pay taxes and social security contributions for a number of years if you don't have that household registration in order to buy a house. Now, this is not entirely new. Back in, I believe, May or June, some cities like Hangzhou and Xi'an had already rolled back some of these restrictions. But what we are hearing is Beijing is looking to expand this relaxing of these curbs to bigger cities like Beijing and Shanghai. On top of that, they are also looking to remove the distinction between first home purchases and second home purchases. What that does is it paves the way for lower down payment ratio and lower mortgage rates on second home purchases. And the third thing that they're planning to do is to remove the distinction between ordinary homes and luxury homes. And the intention is that hopefully that would encourage a sort of consumption upgrading to increase the demand for larger homes. So this is all in a package of demand-side policies that would hopefully inject more demand into the housing sector. And bear in mind, we also previously reported some time back that the government was mulling allowing homeowners to refinance their existing mortgages with banks as soon as this month. We're hearing that it could be a two-step process with a cut of up to 80 basis points to existing mortgage rates.
Min Min, the question really is, will it work? We've seen a slew of measures before to prop up China's economy. They have failed. Might it be different this time?
Yeah, that's the thing. So as you said, we have already seen some of these measures being rolled out in the past, and we're in the fourth year of the property downturn. And if you look at the August numbers, both home prices and home sales deepened decline. In fact, home prices had slid at the fastest pace in 9 years, and that was partly because some city governments had rolled back any restrictions on price guidances of new home prices. That led to developers engaging in a price war to attract home buyers. And according to one of the PBOC surveys of home buying sentiment, many people still believe home prices will continue to slide, so they're still staying on the sidelines. So it's hard to say. Obviously, it is a positive step in the right direction because it allows those people who were previously not eligible to buy houses in the big cities, they may now be able to do so. And already you're seeing the stocks of those share prices of the developers on the screen. They're all pointing out quite a big pop, up to 8% for one of those shares. So pretty good news, it seems, for the sector. But as to whether it will really translate into actual stronger demand, I think that's something we need to wait and see.
That's right. Proof is in the pudding. Min Min Lo, Bloomberg's China correspondent, thank you so much for that. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Neuberger Berman Senior Portfolio Manager Steve Eisman has changed his view that Donald Trump will win November's U.S. presidential election, saying it's now a toss-up. He also told us that markets will be fine with any political scenario apart from a clean sweep by Democrats.
My prediction was basically that Trump would beat Biden. I don't know if you've noticed, but he's not running anymore. So I withdraw the prediction. I have absolutely no idea who's going to win.
Okay, I was going to ask you, do you think that that means that Harris has a better shot then than Biden would have?
Well, there's no question she has a better shot. You know, I think the election, like everybody else thinks, is a toss-up.
A total toss-up. So it's interesting because we're in good times, right, economically. At least we're not in bad times. And usually when you're in good times, the incumbent wins. I know she's not Biden, but she's part of that package, right? She's the incumbent vice president. Why do you think Americans are so dissatisfied, or at least that dissatisfied, with this administration?
Look, I think the big issues, I'm not telling anybody who to vote for. You know, the big issues that people care about are inflation. Yes, it's come down, but it was bad. They care about the border, and that's been bad. That's gotten better, but they remember. And you know, that's what I think people care about, and that hurts the administration.
Well, when you think about the policies, and I think it's fair to ask about what you think about both of their policies, Trump and Harris at this point in time, because the economy is such a big part of this election. What do you make of what they're putting forward? Which plan would stimulate more growth?
So I have sort of a very almost simplistic view of the implications of the election for the market. So if Harris wins, but it's a divided Congress, the market's fine. And if Trump wins, if Harris wins and it's a Democratic sweep, the market's going straight down. I'll get back to why in a second.
Terribly unlikely, though.
Well, I don't know if it's unlikely or not, but I'm just saying that's what if that happens. If Trump wins and it's divided government, the market goes up. If Trump wins and it's a sweep, the market goes up. So the only circumstances I think under which the market has trouble is a Democratic sweep, and that's because you know the Democrats are talking about raising taxes, and Markets don't like that. That's very simple.
The reason I say it's unlikely is that the Senate, there's so many Democratic seats in the Senate.
It's extremely unlikely, but given what's happened, I'm not willing to go out and make a prediction that can't happen.
Neuberger Berman Senior Portfolio Manager Steve Eisman speaking with our colleagues Sonali Basak and Matt Miller. Of course, we just broke the news that BOJ stood pat as expected at 0.25%. We're awaiting comments from Ueda, perhaps on the direction that it may take later in the year. Might we see another rate hike? Remember that swaps markets say it's going to be pretty difficult for the BOJ to make another move. But when you speak to economists, they say 7% chance of that happening. Nikkei futures pointing to gains being maintained. We're looking at the yen at 142.09. Strengthened by 0.4% versus the USD on the back of that decision. Plenty more ahead. Keep it here with us. This is Bloomberg.
So there is no strong reason why BOJ needs to take action right now because the domestic demand is not very strong. But still, 3% and Japan's low interest rate, there's a big interest differential. So it's possible that yen, will start to appreciate, but remain at a quite depreciated level than the past, like 120 or 130.
And that was Keio University Professor of Economics Yuri Shirai speaking to us earlier on the back of the BOJ non-move, staying pat at 0.25%. We're, of course, awaiting that the comments from Governor Ueda. Might he give any indication of the moves the BOJ might make later this year? Will there be another rate hike? The yen, 142.06 right now, inching higher versus the USD by 0.4%. Let's get more analysis from our crew right here, Bloomberg MLife strategist Mary Nicola, of course, Bloomberg Intelligence Chief Asia FX Rate Strategist Stephen Chu, also joining us for this conversation. Mary, I mean, this was very much expected after that 50 basis point move by the Fed. All the central banks are just waiting to see what that impact might be.
Absolutely. And so you saw that first stage. Now there's like an everything rally because of the Fed, because we've got easing monetary conditions and the Fed and the U.S. economy is doing well. So things are laying the groundwork for equities, but it's now about what the other central banks are doing. We saw the BOE didn't do anything. BOJ wasn't expected to do anything, but they're likely to lay that groundwork. And I think the market to some degree is underpricing that.
So there might be a surprise, Stephen, in what Ueda says later today.
I think he'll be more hawkish and sort of prepare market for a potential rate hike, say 25 bips at the October meeting. I think what's interesting is if you look at the recent comments from the BOJ members, they are quite hawkish. For example, like the speech from Tamura is really impressive. He basically said that the neutral rate for Japan is near 1%, and the central bank should really hike rates all the way to near 1% by 2026. So that means a gradual rate hike over the course of next one to 2 years.
So possibly a surprise, possibly hawkish. But you know what? The swaps markets say it's going to be so difficult for another rate hike later today. But on the other hand, 70% of the economists we surveyed say, you know what? It's going to be a go.
Yeah, I think so. I think the Bank of Japan is actually prepared to hike in October. It will be a shock to everybody if we see consecutive rate hikes from the Bank of Japan, like historically speaking. But don't forget now the quantitative easing tapering, or the QT, as you said, if you look at the maturing JGBs, it's actually in autopilot. So basically, the Bank of Japan is still shrinking their balance sheet all the way at least until March 2026. So even without a rate hike today, they're still tightening, so to speak. So that's why they're still on course for further rate hike. Nothing has changed, but they probably want to stabilize the boat a little bit, especially on the back of a 50 basis point Fed cut yesterday.
So, Mary, what is the BOJ strategy? I mean, this is a cautious approach. Slowly, it is in no rush to do anything right now?
I think I'm very much in Stephen's camp. I do agree with everything he said. And the fact is that they're going to lay the groundwork. They have been laying the groundwork in terms of they're looking to hike rates. The key thing now is because, as you mentioned, the swap markets is underpricing any sort of expectations of hikes for this year, which means that they have to be explicit and clear about what they plan to do, especially to avoid any surprise shocks or any moves that we saw like in July.
That's impossible. This is the BOJ. There's no clarity when it comes to the BOJ. It is there to confuse you.
True, but at this point, you don't want a repeat of what has happened in early August, right? And so if you want to avoid that, it's all about your forward guidance.
And Stephen, just very brief there, we saw the yen breaching 142. Where do you see the yen trading?
Yeah, I think right now we are at a fair level because according to our fair value model, we had dollar yen at roughly just below 143, which is where market is trading right now. And when we look at market position, the latest data show that market now, the net long in yen is at a share of about 40%, which is, again, historically quite high. So that tells you that a lot of those carry trade unwind probably has been done. There could still be more room for carry trade unwind, but at least for now, everybody will just take a breather and look at what the Fed does, what the BOJ does. Of course, the direction is still for further dollar yen downside, but the pace will be a lot slower from here.
We're also keeping a watch on what the PBOC does, and today that fix, wow. How are you reading that?
I mean, actually, the fix, it's somewhat in line with our forecast model. So basically, it's what the FX market feeding through to the PBOC, nothing special. But all you can say is the lower fixing, of course, is because of the spot dropping. So people talk about after the Fed cut, now a lot of the exporters are finally coming back out to sell their dollars. But of course, what China wants is a stable currency. They don't want very fast depreciation and, of course, very fast appreciation. So that's why there were news about actually state banks are coming out to stabilize and buying dollars from here. So, of course, from here, weaker dollar, we see lower, weaker dollar China, but at a very gradual pace as well.
Does it pave the way now for further easing in China without really hurting the currency?
I think so. I think that's one of the reasons why they've let it slip gradually. If you have a bout of weakness as a result of, let's say, the impact of the interest rate market, that it's a little bit of a buffer, right? So they've created themselves a buffer. The Fed's helped them create a buffer. The overall risk on environment has helped them create a buffer. And not to mention that all of this, especially with the yuan strengthening, this is such a good positive environment as well for other currencies in the region, because we have to remember just how dependent a lot of these currencies and how they move together, and especially the likes of the Sing dollar, the Thai baht. There's such a strong connection between the yuan and them. So I think that also creates a better environment for Asian FX.
And we have a line here out of Thailand where the Thai Finance Ministry says it wants the key rate to move with the global trend. How are you reading that?
Yeah, I mean, we've heard a lot of noise from the policymakers on Thailand's side looking for them to just cut rates. And I think at the end of the day, what we've seen from the Bank of Thailand is that they will just do what is allowed or what they think is deemed appropriate for their economy, because inflation is not an issue for them. In fact, if they see some disinflationary impact, they should be already cutting, but they don't want to as much. And of course, again, with the currency appreciation, that gives them another buffer to allow allow some weaknesses.
But the thing is, there is a conflict there. That is the view of the Finance Ministry. When it comes to the Bank of Thailand, the central bank, it says it doesn't have to go. It doesn't have to go the Fed way.
Yeah, it doesn't, absolutely, and we've seen that over and over again. And they've pushed back on the Finance Ministry repeatedly, even on the Prime Minister as well. So it's all about what's best for their economy and what they see fit.
And Stephen, your thoughts on it and how this might play out in terms of the Fed's strength or weakness?
Well, basically, I think we can see further dollar downside from here. I know there's a lot of rate cuts being priced into the market, but still, like in a rate cut cycle market, we just keep pushing for further rate cuts until the Fed say that they're done cutting rates. So basically, market will be in a sell on rally mode for the dollar. As you can see yesterday, right after FOMC, there was some dollar recovery. But actually, when London came in yesterday, we saw dollar selling off again, so entering today as well. So that's pretty much where market is going to be at least until the U.S. election in November. Basically, there's no obstacle for this dollar weakness.
All right, again, we have some breaking lines out of the BOT, the Bank of Thailand, saying that it does not have to follow the Fed, and another line here that the Thai baht strengths on the dollar weakness as well as the gold rally. Bloomberg MY strategist Mary Nicola and Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu, thank you so much for sharing your insights with us today. Now, New Zealand Prime Minister Christopher Luxon says his country will explore opportunities with the U.S. regardless of who wins the November election. He also told us exclusively about his outlook on the economy and why he's optimistic about a recovery next year.
We inherited quite an economic mess, and we've been working our way through that. I mean, the first part is to get government spending under control, which was a big driver of our domestic inflation numbers. As you know, when inflation goes up, interest rates go up, and as a result, the economy's been in recession, and that's led to some rising unemployment as well. So, in essence, what we're having to relearn is the lessons of economics that we learned 35 years ago, and this generation of political leadership making sure that we deal with those. And that's why, there's some encouraging early signs. We're seeing inflation has come down from 7.3 down to 3.2. We expect it to be in the mid-twos in this quarter. We've seen certainly our first interest rate cut, and we're now on a downward trajectory on interest rates. And we've also seen business confidence at a 10-year high. So, we've now got to work our way through the spending, inflation, the interest rates, get growth back into the economy and keep people in work.
How much can the rate picture really help, particularly when it comes to animal spirits, right? As a former business leader, would you, with full respect to RBNZ independence, would you expect them, or I think that it's maybe a good idea for them to follow what the Fed has done, which is jumbo-sized easing?
Well, look, I mean, that'll be ultimately a decision for the Independent Reserve Bank, but there's two more opportunities before the end of the year to lower rates. I think what's been important is to make sure that fiscal policy and monetary policy are working together, and that's the bit that I can control, is certainly fiscal policy and making sure that we've got good, effective government spending, that it's not actually leading to an overheated economy and high inflation, which is what was the situation that was happening. And then for us, it's about getting the platform in place for growth, because New Zealand has a fantastic future. I mean, it really does. It's got so much potential, but we've really got to create the conditions for that future growth.
Does that mean you've got limited fiscal space to do things on that side, if we're talking about fiscal restraint?
Yeah, so we certainly have limited and constrained ourselves with respect to our operating allowances going forward to make sure that we've got good fiscal consolidation and financial management in place, and we're bringing that discipline back into public service and back into government spending. But equally long term, or even medium term, we've got a lot of opportunity with respect to upgrading our infrastructure, embracing more science, technology, innovation, getting our education system working right, getting rid of red tape, making it an easy place to do business, and certainly international trade. So, New Zealand is well positioned in the world, I think, with the Indo-Pacific region, rapidly, growing middle classes, as you well know. We've got really strong, liberal, social democratic institutions in New Zealand. We've got abundant natural resources, and we have really outstanding people.
Do you worry about trade protectionism and punitive trade policies, particularly if there is a second Trump presidency? Well,
look, I think, in terms of the last 20 years, there has been, New Zealand has no doubt about it benefited from an international rules-based system, trade liberalisation. We're a small country without, tariffs, which we removed, decades ago in New Zealand. So we're competitive, and we really benefit, and we've been behind things like CPTPP with Singapore as the original sort of partners on that agenda, and we continue to believe in that. But no doubt about it, in the last 20 years, there's been quite a seismic shift in some of that thinking. So irrespective of, frankly, who gets in the US, there's still lots of opportunity for New Zealand, and frankly, we're going to work with whichever president the US people determine and decide on who will become president.
New Zealand Prime Minister Christopher Luxon speaking exclusively with the Asia Trade co-anchor Heidi Strutwart in Auckland. Plenty more ahead. Keep it here with us. This is Bloomberg. Canada is trying to strengthen relations with Southeast Asian nations as trade tensions with China intensify. Canadian Trade Minister Mary Ang spoke to us from Laos, where she's attending an ASEAN meeting.
In ASEAN, which is really important part of Canada's Indo-Pacific strategy. What are we doing here? I mean, I over the last year and some have taken several trade missions specifically here into the ASEAN member states. I've been to Singapore, to Malaysia, Vietnam. I'll be in Philippines and Indonesia later this year, and other ASEAN markets into next year. But what does that really mean? It means businesses, Canadian businesses, coming here into ASEAN, creating those trade and investment relationships right here in the region. So we're creating those partnerships. We're creating those investment partnerships and those relationships. And when you're talking about supply chain, it is the company that is manufacturing a part perhaps here or creating a technology in Canada, creating that kind of collaboration and partnership to make those supply chains more resilient. And it's underpinned by strong FTAs. I also want to say to ASEAN colleagues here, remember, when you trade with Canada, you are trading with over 65% of the world's economy through Canada's free trade agreements. We have them with, in really important markets like that in the North America or the European Union and many of the Asian Pacific countries through the CPTPP. So working with Canada and us doing this with ASEAN member states means more resiliency underpinned by a rules-based trading order.
At the same time, we see these tariffs when it comes to Chinese EVs, potential counter tariffs, potentially more negotiations on other trade measures as well. Do you see this as sort of potentially, dangerously slipping into the possibility of a tit-for-tat trade war? And does that risk actually worsen depending on if there is another Trump presidency after the election?
Well, Canada has always been, through our entire history, a rules-based country. We stand up for the rules-based international order. Canada is an open trading country, but we are a fair trade country. What we negotiate and what we stand up for are standing up for industries to ensure that there is fair competition globally. Fair competition for us also includes making sure that we are tackling climate change in the growth of our economies, making sure that our workers, have fairness in pay and standards. I mean, that's fair trade, and I do believe that our trading system around the world, I believe that other countries want that as well. So as a rules-based trading country, Canada lives up by our standards, and it is a challenge today. But I think we need to work through those challenges. But I think we also need to be honest about those issues that is causing perhaps some of the issues that is causing unfair competition. And if I think about the work that we do in Canada through the Ottawa Group on reforming the WTO, that's some of the work that is really important for Canada. As well, making sure that we are not only standing up for the system, but being a real participant to ensure that the rules-based international order is something that we continue to work with our friends around the world to do.
And that was the Canadian International Trade Minister Mary Ang speaking to Bloomberg's The Asia Trade. Well, India's been trading for about 2 minutes now. Not to be outdone, the benchmark in positive territory, parting along with the rest of the region. Remember that this is already an overstretched environment for the market there. Stocks trading at least 20 times what they are elsewhere in the world. The Sensex index up 0.3%. Nifty index also in positive territory. In terms of the rupee, trading 83.56 versus the USD, currently higher by about 0.1%. Plenty more ahead. This is Bloomberg.
I hope that the current disposition would stay in power. it's more than individual. I would, and of course, I'm a great admirer of the current president. He did a fantastic job in terms of bailing out Sri Lanka in the midst of a chaos where no one wanted to take over. And he's bailed it out, and I think today Sri Lankan economy is in a far more comfortable position.
Chowdhury Group Chairman Binod Chowdhury speaking to us earlier this week at the Milk in Asia Summit. Now, Sri Lankans head to the polls this weekend for the country's first election since defaults on sovereign debt triggered the worst economic crisis since independence. Beijing and Washington have both committed millions of dollars of loans and investment as their rivalry hangs over the vote. Bloomberg's Dan Strumpf joins us now from Colombo. Those deepening U.S.-China rivalry and overhang here. Dan.
Yeah, that's right. I mean, this is actually one of the closest races that Sri Lanka has had in really its recent history. It's come down to a three-way race. What's essentially the Sri Lankan political establishment up against an insurgent candidate who comes from a leftist Marxist background, who is coming into office with the promise to really sort of shake things up here in Colombo. So it is really a closely watched election here, and they may very well go to a runoff actually for the first time in history after Saturday's vote.
We know, for instance, a lot of issues like the housing slump into its fourth year. How is it impacting sentiment on the ground? How are voters feeling right now? How are they likely to vote on the back of that?
So, there's really a sense of, desire for change on the ground. I mean, among people that I've spoken with, there's really a lot of grassroots support that you're hearing for something different, for sort of a different way of running things. Of course, IMF bailout has been a major source of progress for Colombo in the years since the economic crisis really upended this country. That being said, a lot of the measures that were taken to bring that bailout into effect, things like higher taxes and governance overhauls, some of these measures have been really unpopular among day-to-day Sri Lankans, and so the incumbent administration really has an uphill battle in sort of selling some of those measures as they go into the vote this weekend.
There's also trepidation among investors and assets. Sri Lankan assets have been under a lot of pressure. Any chance at all of a reversal in sentiment?
Well, there could be. I mean, some analysts that we've spoken with have said that if the incumbent administration, somehow loses, or if there's a major upset in the vote, you could see a big pullback in the Sri Lankan rupee. Of course, the Sri Lankan rupee was really under a lot of pressure during the throes of the crisis in 2022, has staged a big recovery. So that will be very closely watched, and the turbulence in that currency, of course, is really responsible for some of the pain that many Sri Lankans experienced during that crisis. So that I think might be a real barometer going into the election.
You talked about how the IMF deal is in focus. How about in terms of foreign policy, relations with India, for instance?
Yeah, I mean, so Sri Lanka is really in a sort of special place geopolitically, right? It lies just south of India and the Indian Ocean. It's on the sort of China's Belt and Road, right sort of square in that sort of sweet spot for China. And China has been really responsible for a lot of the infrastructure buildup that you see that you've seen here in Sri Lanka over the last decade or so. It's visible all across Colombo, and everything from seaports to roads, highways. A lot of this has been built with Chinese investment, and that's made India nervous. I mean, India and China are, of course, historic rivals. India and the U.S. have become closer as they have aligned against China. So you're seeing a lot of U.S. interest in this election as well. So geopolitically, I mean, there's really a lot going on in Sri Lanka, and you're seeing a lot of push and pull between India and China here.
Dan Stroff, thank you so much for that. Now, some top corporate stories we're watching. Bloomberg has learned that Johnson & Johnson is boosting its offer to settle baby powder lawsuits to more than $8.2 billion. Sources say under the new terms, claimants could get bigger payouts and about $650 million in legal fees covered. The drug maker earlier offered a $6.5 billion settlement. J&J maintains it's now withdrawn talc-based powders never caused cancer. Nike has ousted CEO John Danaher and is bringing longtime executive Elliott Hill out of retirement to return the struggling brand to its glory days. Hill joined Nike in 1988 and served as president of Consumer and Marketplace before he retired in 2020. Here's how it's looking at markets. China in focus. That is it from Bloomberg Markets Asia. Horizons, Middle East, and Africa is next. This is Bloomberg.